Hmm. Good morning, everyone. Welcome to Breakfast Club on September 10th. I'm John Hutchinson along with Jeff Wood. Jeff will not be speaking very much today as he is a little under the weather. So let's pray for less rain for Jeff, and hopefully he'll be able to get his voice back and feel better for today's Millionaires Trading Club session at 11 a.m. But I still have plenty to cover with you, including some exciting little previews and notes and updates. So let's get down to it. I want to talk briefly about um, sort of this um, duality of the stock market right now, where we have a small group of positives weighed against a growing group of negatives that are uh, at some point it's going to something has to break. And I don't mean break as in break glass in case of emergency. I mean break one way or another. Um, the positives right now, as evidenced by several recent AI earnings announcements. Broadcom up like 32% or 10% rather. Oracle up 30%. Um, is fueling the enthusiasm of Wall Street around AI stocks, and that's largely pushing markets higher. Um, and the second, somewhat of a positive as far as Wall Street is concerned, are the rising rate cut expectations by the Fed. Meaning now there's something like a 99% certainty not only that the Fed will cut rates in September, but that the Fed will cut rates by a half point in September, and will continue with I think it's in October, November, somewhere between the end of October, beginning of November, another rate cut, and then another rate cut in December. So again, we saw this last year where heading into the fourth quarter, the Wall Street's expectations for rate cuts went um, went way high and largely proved not to be accurate as the Fed was forced to hold rates. And now we discover that on the negative side, not only are we experiencing rising inflation, but I don't know how many more revisions they can keep making, although the revisions released yesterday by the BLS are known as the first annual revisions. They do those twice a year. That was, a net nearly a million jobs not actually created. And a couple that with the massive revisions in August and some revisions again in September, um, it's certainly creating an environment of a weakened labor market. So, as we sort of talked about as we did talk about on Monday, we want to keep our eye on the unemployment rate that needs to stay below 4.5%. If that unemployment rate goes above 4.5 and begins heading toward 5%, that will create a major headwind on the stock market. Uh, Rising inflation, we get CPI tomorrow. We have PPI this morning, which is probably out. I just haven't had a chance to check. Jeff can check in the background for us and see what the headline and the core PPI is on that. But for CPI, expectations right now are for 3.1%. Anything that rises above that does two things. First, it calls into question whether or not the Fed can justify a very large rate cut for the second time in 13 months at a half point, which is balanced against this weakened labor market. In other words, all of these forces are working counterproductively. If we had a strong labor market and AI enthusiasm, the stock market would be over 7,000 on the S&P right now. But we don't have that. But with the AI side of it, you can see Wall Street clearly trying to push tech stocks higher, 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 higher. But that's also creating a gap in the market. And we'll start exploring that as we go through the rest of September and into early October. And as we get into the next round of earnings season, looking for those gaps. That's everything on the consumer, cyclical consumer uh, staples side, healthcare, real estate, etc. It's the rest of the market is the rest of the market being left behind. So these are things that we need to keep our eye on because, as I said, either the labor market improves because of rate cuts, but I'm not convinced that that happens. As I mentioned on Monday, one of the factors that I think that is affecting labor, or the limited amount of labor being added, is to a degree the incorporation of artificial intelligence for streamlining business. But the second obvious one is tariffs and the impact of tariffs on corporate earnings. So we're really just at the forefront of that impact, because the reciprocal tariffs didn't go into effect until the beginning of August. So we're really not going to see until October, and maybe not until January, the true impact on businesses of those tariffs, where those tariffs are relevant, where those companies are paying for them. The other thing that I'm going to start researching is the impact on small business. Small business, always the key driver for growth in the U.S. economy. Um, I know of a couple of companies that have gone or have announced that they're closing their doors. One is a furniture company in North Carolina that my wife Liz and I bought a console from them, and they announced that they were closing their doors because wood costs from Canada too high, steel from anywhere too high. They can't make their furniture anymore. That's just an anecdotal one company, so that doesn't mean it's the whole economy. But that's something to start in your hometowns. Start asking business owners how things are, especially your small businesses, your restaurants, your bars, if you have retail shops, etc. Start asking them how business is. And if you go out to eat, just keep a visual head count during key dining hours. Are you seeing fewer people than you're accustomed to in your favorite restaurant, or fewer people at the bar during the football games on Sundays, whatever? These will be um, these will be triggers for you. It's sort of the old buy what you trade what you see, or invest in what you know kind of thing. But it gives you a sense at your community level that can extrapolate out wider about what consumers are doing. If consumers are beginning to pull back uh, on especially the that type of spending, um, whether it's eating out, whether it's spending money at local stores, etc., that's a warning sign. And it is a recessionary warning sign, because typically small businesses prices tend to be, they're higher than Amazon, obviously. Um, Restaurants have had food costs explode higher over the last couple of years, and bars and restaurants labor costs are higher. So if consumers aren't spending, then you'll see that impact at the local level. I'm doing that on my own when I go out to eat, rarely with Liz, or if I visit there are a couple of shops that I really like um, here in my hometown, and I can tell you that a couple of business owners that I've spoken to have said they are seeing people spend less money. So that's a warning sign. Doesn't mean that everything's going to go off the cliff. It's just a warning sign. But these warning signs begin to add up. And at some point, that's that breaking point. So, uh, enough of all the bad news, so to speak. The second thing that I want to keep my eye on, and you should too, is the 10-year Treasury yield. This is a proxy for long-term growth, and the red line at the 4% level is becoming a line in the sand for the bond market, where yields above 4% means the bond market is less worried about economic growth into the future. If yields continue to fall below 4%, and they have been trending down over the last 2 months, then that implies that the bond market has significant worries about growth in the US economy in the year or years ahead. There's another function with the yield curve, which I'll dive into next week because it takes a couple of minutes to explain. Um, there are two functions in the yield, aside from the yield curve being inverted. When it's inverted, there are two other functions known as bull steepening and bear steepening. One of those is bad for stocks, and the other is not bad. So next week we'll look at those and we'll see which of those patterns is developing in the bond market, because that can give you some ideas on when and how to hedge for your portfolio, when and how to start pulling back on position sizing, uh, decreasing capital and in the market and increasing money on the sidelines. These are steps that can be taken in advance. I'm not telling you that the world's going to fall apart, uh, but readiness is all. And being prepared means that if something does happen in the near future, then you have a plan and you have a way to trade through what will be more pain for everybody else, but more gain for you. So, with that, the next thing I want to look at, I mentioned on Monday the development of a new AI² index. That's the next generation. I'm calling it the next wealth wave. The companies that are positioning or being positioned uh, in the artificial intelligence market to have significant growth, and that spanned everything from mega caps down to micro caps. What I've started building is an index dashboard. I'm in like the early stages, but just for fun, and because Jeff can't really speak a whole lot this morning, I'm going to show you what I'm starting to work on, just so you have an idea. But before we get to that, I want to show you 1 week performance. This is the top 10. I've just given you the numbers. I'm not giving you the tickers today. Just that leaves you wanting more, right? That's the way you do it in marketing. But the key here is look at these 1 week performance percentages. I'm not going to dive into the stocks right now. What I want you to see is how this relates back to what I was talking about, or on the issue of AI enthusiasm. That's 10 stocks where the lowest stock is 17%, up 17% in a week, and the highest is over 40%. Um, would I like you to have had all of those stocks last week? Absolutely. But if we can start getting you in position for them in the future, these types of results should be able to be replicated. The next 10 stocks from number 11 down to number 20 ranged from 17 to 11%. So that over 20 stocks in this index already had greater than 10% gains in the last week alone. That's what I mean by AI enthusiasm. And that's why I'm talking about this so much already, because even if you're an investor, just a stock investor, you need to have exposure to the right stocks beyond the Nvidias, the Apples, the Palantirs, et cetera, because those companies will continue to grow, um, but they're much more difficult to get into to the next phase of growth for those companies. Whereas you start looking at mid caps, large caps, mid caps, and even small caps, there's more opportunity for substantial growth over the next 12, 24, 36 months, even against the backdrop of potentially weakened economy, uh, maybe a recession, maybe not, who knows. But positioning yourself now and earlier gets you on board some of those stocks. You've actually been able to trade some of the names that are in this index in the Millionaires Trading Club service, for certain, and occasionally within income masters, occasionally meaning Google, for example, or Nvidia. So, but there's this idea of building an index is right now, um, it's tech heavy. So let me give you an example of that. I want to switch over to this new dashboard that I'm building. 1 second here. Let's go over to this example. Now, bear in mind, this is literally version 1, so it ain't pretty. It's ugly. But I want you to get a sense of what we're working toward in terms of sharing information. So this is the initial build out, and this is what I'm talking about. You can see how this is very heavy in the tech sector. All of this, 60% is technology, 26% communication services, and then you get this little wedge all down here, which are all of these other ones. But it's the bottom two: healthcare. No, I'm sorry, defense didn't show up. That's going to be in a different category. Healthcare and defense stocks um, are the two areas where I think in the next, if you're a longer term investor, next 5 to 10 years, there will be more opportunity in those two sectors as adoption of artificial intelligence begins to take place. I mean, anyone who's ever been to the doctor or multiple doctors knows it's I wanted to say a really bad word, but it's impossible to get your health records from multiple doctors into a singular place, right? Everything's difficult. Um, Artificial intelligence in the future has the potential to solve many, many problems beyond just like an AI doctor. We're talking about data, health records, preconditioning, uh, meaning records that are leading to something that could be something else in the future. I mean, there are so many applications beyond just where healthcare is right now, and I'm just thinking of one. Defense stocks, Palantir, Howmet Industries, which are Howmet Industries, Aerospace, HWM. We traded that back in three stock 2 years ago. Off topic, three stock is already up over 2% in 2 days. So you're doing really well, even with a lousy entry on one of the three stocks there on Monday. But overall, up 2% plus in 2 days. So very nice to see that. But there are far more applications in these other sectors of the other industries in the economy that no one's thinking about yet. And if we can think faster and sooner than Wall Street, then we can be ahead of the game on some of these other types of sectors. And if I scroll down a little bit further, clear my drawing there, close that. This is the market cap distribution, and this is what you would expect. That, and this is what I'm talking about. A lot of the opportunities are going to be here in large cap, mid cap, right? These are the next companies that are going to have the potential to explode, even small and micro. But remember that once we start getting into micro caps, you start talking about 1 out of 10 is going to be a hit. So we'll have to have more rules, and I've built a set of rules that I'll share at some point in the near future. But what should help you understand the benefit in this is this. This isn't built around the mega caps that you already know. They're represented, but they're not the largest representation of this index. So between going beyond technology into other sectors and industries, we're also just expanding the distribution in large cap, mid cap, small cap, and even micro cap. And I think there was a nano cap that almost made the list. It just missed. And so what I'm working toward is, again, first iteration, right? A sample table. This would be the index. I haven't. This is just me doing some basic fun math. So as an example, so um, uh, don't put any weight into any of the data that you see necessarily. It was just literally something that was built to test. But I can tell you that those six, one, two, three, four, six, yeah, those six stickers are actually in the index that we're working to build. But when we look at this, what we plan on doing is also being able to build out things like, is this a sell? Is this a buy? Where are we? Are we weighted toward buying this? Building in option strategies around some, but not all of the stocks. Well, many of the stocks, if not almost all of them, are optionable. Doesn't mean you're actually going to trade options. But one of the things that we want to do in Millionaires Trading Club is what's called decision tree analysis. And what that is when you're looking at a stock, and it doesn't matter what the stock is, it's determining what the best trade is based on the numbers, the performance, the risk, and the income available to you. So while most of the time we gravitate toward a bull put spread, are there other tactics that you should assess to determine whether that bull put spread is the best trade for that specific stock, or a single sided put, just a single sided put option? What is or what are the best tactics, and having a methodology to walk through quickly, so you don't have to. It's not a tree it's not a 50-foot high tree, right? We want to keep the branches low to the ground, easy to understand and easy to execute, so you can make the best decisions about trades that you may be making on your own, or even going beyond the trade recommendations that we make in any of the services. So with that, I think that's most of what I have to share. Jeff, do you have Thinkorswim up and open?
I do.
As he whispers. I'll turn the screen over to you, and if we could take a look at the Google.
Yeah, 1 second.
And Jeff is really excited about an idea he has around MicroStrategy, which he's building a little thesis around that. That's MSTR, right? MicroStrategy. So stay tuned for something on that in the next few weeks as part of Millionaires Trading Club. Or maybe even when we get down to the live event. So here we have Google, and we saw the gap up move last week, just pre-market on Wednesday, and we had originally set up a three-tiered laddered put spread beginning at the 210 level all the way down to the 197 level. And that would have worked out. I think the net on that would have been about at one contract would have been about $124. So with Google still racing higher and opening higher again this morning too. Yeah, it looks like it's opening around 240. Uh, I I would look at this again, but in this instance, because there's a large gap in the chart, one of the things that I would look at is I don't want to be close to the money. I don't want to be that close to the money, especially given all the concerns that I've laid out for you already today. One of the things that I would look at on a stock like Google is, can I build a laddered put spread that can fill the gap? So I would start a spread somewhere around the 225 level, and I would build out. I think we did five wides last time, so keep it simple, keep the capital low. So if Jeff, you want to roll over to the, yeah, we'll start at the 225, and then we can probably go as low as uh, probably 210, I would guess. And I would set this for this Friday again, even though we have PPI. Excuse me. Okay, so PPI came out and it was lower. So core PPI was down negative 1.1%. So that's a surprise, a positive surprise. Let's take a quick look. I don't know if futures would show. Yeah, futures up half percent, and almost a half% on the S&P. So that worked out. That'll work out nicely. So hopefully CPI will have similar numbers tomorrow. But aside from that, looking at this, so again, I would start at the 225 level because that's the bottom of that gap up. So in this case, Google has to reverse by 7%, $14 a share, to cover that 240 down to the 225 level. So I'm starting at a pretty good line in the sand. And if I build out at a five wide with this Friday's expiration, am I getting enough credit? And the answer is no. So this is a 3 cent credit for a five wide spread. Um, that's definitely not enough. And with the you can see the 225 is already down to 15 cents. Last week, absent earnings, absent other exciting news, we were close to at the money with a gap up move projected in pre-market, and we were getting 88 cents. I think it was 88 cents. So in order to get anything close to that, we'd have to go all the way up to the 235 level. And I feel like that's too much risk. So this is a moment where, again, this analysis of, geez, would I make a trade? Would I not make a trade? Only having a 2.5% uh, range with an expected move there in the 5% range. I think it was 5 points. Um, it feels too risky for me right now. Even trying to build out a multi-leg spread, 235, 235, 230 gets you 53 cents. But it doesn't take much for Google to turn south. So in this analysis, I can't get paid reasonably without being able to take a little bit more risk, um, I can still get 3 5 wides. That last one would probably have to be at the 225. Yeah, we would have to go to the 225. No, 232, 227.50. Can't trade the 230. So yeah, the next one. So we wouldn't even be able to do 3 legs because the 225, 220 would be too big. Excuse me, would have no premium. So an alternative is if we start at the 230 level, you're still getting roughly 30 cents. That's pre-market. I would kill the 235, 230, and I would go um, to the 230 and 225, which would give you a 5 wide, about 15 cents. Now, it's not a lot of credit, but it's still, pulling out the old calculator, we're talking 5 wide, right? So 480. So we pull out 15 cents, 14 cents, give it a nickel, you're talking about 9 cents, 10 cents times multiple contracts. You might be able to do 5 or 10. There might be 30 or 40 or $50, but is it worth it? Is it worth the trade to grab that limited amount of credit? And the answer is no. Because when I did the original ladders, what I had was I had a top, middle, and a bottom, and they balanced out. So this is part of that analysis process, and it didn't take us long. We did it in just a couple of minutes. Where I don't like where Google is at, I don't want to be forced that close to the money. I can go back and if we go back and look at the chart and plot a 5 day moving average, the issue with that is um, that 5 day moving average is going to be right inside of the gap up move, which means we don't have a solid understanding of where support would be following that gap up move. So one of what we're helping you with here is when you have a stock that has a significant gap up move, if you can trade some for something in the gap, that's reasonable. If you have to follow the gap, look at the premium and look out at how close you need to get to the money in order to build, whether even if it's a single spread or a single sided put, or a multi-leg spread. The closer you have to get to the money in order to get reasonable premium, that's a reasonable time to say I want to stand aside and look for a different stock or look for a different opportunity. So a little bit of a preview of some decision tree analysis. So my final answer here would be I would not trade Google. Uh, a 5 wide spread isn't paying enough. I could start at the 230, but I'm still not getting paid on a net credit basis. And that would have put me 5% out of the money, and I would have been okay. And what I don't want to do is I don't want to go to next week's expiration because that's too much time. I'm trying to find trades that I can make in just a couple of days where I can get in, get paid, get out. If this 10 cents, 14 cents were part of a multi-leg spread or at least 2 legs where I could build another leg on top, then I would say this could be a trade, but it's not. So I would stand aside this week between CPI tomorrow and the University of Michigan consumer sentiment on Friday. It's a good week to reduce exposure because both of those can move the markets negatively. They can certainly move the market positively, but then we're gambling on the outcome. So I would sit tight and I would wait until next week, and we'll try something different next week. But for Google as it stands, if we want to take a quick look at, uh, oh, not NVIDIA, Netflix. Let's take a quick look at Netflix. All of Netflix's big shows are starting to hit. Um, so this is still a fairly good time. Do we have the chart real quickly just to get a baseline on? There it is. There's my trading assistant. So we have a slow rising channel, although the stock in the last 2 weeks, I would say, is sideways. So more of a rising wedge and pretty reasonable support, roughly 1200-ish. Feel like we're still going to be awfully far out of the money But let's see what the premiums are anyway. We'll start building around the 12. Hang on, Jeff. Don't go to the, stay on the chart for 1 second. Middle of the current trend, the green, red, green spinning tops in the, go back about 6 days. Yep, those three right there. What's the top level average out there? About 1225, 1225, 1230. Let's start at 1225 and see what we can build on Netflix and see if it's worth it. So again, 12 September would be the expiration. So we're looking for essentially a 2 day trade, and going five wide is going to actually pay reasonably well, 44 cents. That's not awful. Um, what if we go up to the 1230 and the 1225 to start instead, and then just change the second one to 1227. No, 1240 is too high. 1227, one and 1222. So that's reasonable. If just a two-legged spread, uh, you have declining risk. So 51 and 46 cents. That's pre-market, so you'd have to verify it obviously when the market opens in 30 minutes. But that's almost $1 on a net thousand for one contract at 2 5 wides. It's a 10% return in 2 days potentially. Uh, even if you even if you do a 10 cent closing order, that's going to be 90 cents, 9% in 2 days annualized. That's very high. Um, and even if you stacked contracts, so you could go, uh, for example, if you were trading five contracts, you could trade two at the top, three at the bottom, two at the top spread, three at the bottom spread, and expand the capital, the income from the trade, but leaving the heavier risk, letting the lower spread carry more of the risk than the top spread. So um, that would be a trade idea. Again, sticking with big board stocks, stocks that have momentum, that have volume, that have significant volume on a daily basis. You know, Netflix, while it could be impacted by CPI, um, as I've said before, the one thing people don't do is unplug, right? They don't get rid of entertainment. It's the last thing that they get rid of. Uh, but we're not at that point yet. And Netflix has been consistent in growing ever since the major changes that they made 2 years ago. So there's an idea, there's a trade idea for you, and you can modify those, go a little bit lower out of the further out of the money, probably still pull in somewhere in the 5 to 7% range on the day. Excuse me, on out of on 2 days. I mean, to get that uh, would not be the worst thing in the world. Your max, what's the max risk on that one? Max loss risk on that one, Jeff?
Nine, excuse me, $903. 903.
903. So uh, you're collecting almost a 10% upfront, and then it depends on how one closes. And I would look to close at 10 cents on the top and 5 cents on the bottom. Um, that would be my preference, and that gets me out of the trade hopefully in a day, maybe two. But I'm not gonna. I wouldn't sit and wait for zero on that premium. So Jeff, anything that you wanted to add for today, or hold on to your voice until 11 a.m.?
I'm gonna hold. Thank you.
Jeff is going to hold. Thanks for being my trading assistant today, Jeff. And for everybody else, thanks for joining us here in for today's session. We'll be back next Monday at 8:30 a.m. Jeff will be working with folks during the Millionaires Trading Club at 11 a.m. And I believe we have Income Masters at 12:30 today. So we will see everybody in, let's see, if you had not traded Hood, um, Franklin, if you didn't trade Hood at the open on Monday, Honestly, I would sit tight. We won't be in that stock forever. There's gap up move Monday at the open. I mean, could you get back into it? Certainly you could. I mean, you're not paying that much of a premium. I think from our entry, we're up about almost 6% as of the close yesterday. So, you're missing a significant chunk. Um, you might be better served waiting. And I can't stress enough the one thing that when it comes to the three stocks, they're going to be gap ups and gap downs. Um, over time, they'll balance out. But uh, once I suppose once you miss the entry, you may be better served waiting. I mean, may the stock pull back? Yes, but bear in mind if the stock pulls back, we may also choose to exit. So the difficulty in answering that question is that end of the equation. If we're up 5 or 6 or 7% and the stock pulls back 2 or 3, we may just take our 4% and move on to a new stock. So you'll want to balance uh, your decisions based on not. I'm not saying 4% is like the line in the sand. We're going to exit there, but if you miss an entry and a stock has moved as much as Robinhood has this week, you may need to take that into consideration because if we are able to pull a reasonable gain out of it in 7 to 14 days, we're going to take that gain and move on to another stock. So keep that as part of your decision process. You may want to just wait for the next stock, right? We'll have more soon, I promise. Um, Outside of that, I don't think anything else? Nothing else? We're all good. All right. Thanks everyone for joining us. We'll be back next Monday, and or we will see you in one of your live trading sessions for the remainder of the week. Hope everyone has a great weekend.